Hello everyone. In this recording we're going to go through some of the homework questions in Chapter 6. Okay, so the first question, it looks like we have a small environmental testing firm. They performed 11,400 radon tests for $260 each and 15,000 lead tests for $210 each. Because newer homes are built with lead-free pipes, lead testing volume is expected to decrease by 12% next year. However, awareness of radon-related health hazards is expected to result in a 5% increase in radon test volume each year in the near future. Jim Hart feels that if he lowers his price for lead testing to $200 per test, he will have to face only a 4% decline in lead test sales in 2018. So basically what we're going to do here is we're going to prepare a sales budget. And right now, it looks like we said we're going to do radon test 11,400, 260 each. All right. And we also said we are expecting a 5% increase. Here it is, 5% increase in the radon testing. So that was that was for 2017. So we're trying to put together the sales budget for 2018. What I'm going to do, if I come out here to the right-hand side, you will see your 2017 sales are 11,400. And the expected change in 2018 is to increase it by 5%. So when I do the math, 11,400 times 1.05, which is 105%, I expect to sell 11,970 units in 2018. So if I take the 11,970 units, multiply it by 260 units, $260 sales price, there's your revenue, $3,112,200. Same thing with the lead tests. We said in 2017 we did 15,000 lead tests. And because lead testing volume is expected to decrease by 12% in the current year, we're going to take that 15,000, which are the lead tests we did in 2017, and we will subtract out 12%. So it's really 15,000 times 88%, or 0.88. That gets us to 13,200, which we expect to sell in 2018. Times the 210, and there's your number, 2,772,000. And the what-if analysis, what if we reduced our price from 210 to 200? If we did that, then the change is only going to go down 4% instead of 12%. So I'll take the 2017 sales of 15,000 times 0.96 or 96%. And we'll be able to sell 14,400 in 2018 instead of 13,200. If we did that, multiply it by the smaller sales price of 200, you can see we get greater revenue that way. So certainly we should go ahead and lower our price if our estimations are correct for our sales budgets. So sales budget, very important. You make sure this is the starting. You have to understand your sales budget and how many you're going to sell before we can go ahead with our production budgets. And after our production budgets, of course, your materials budget, labor budget, overhead budget, your selling and administrative budget, etc., etc. So it all rests on this. This is the base of everything else. One of the key factors in this chapter is all of the budgets need to be prepared in a certain order, and it all relies on the sales budget. So we need to do a really good job with that. Okay, here we have a company. They expect sales in 2018 of 201,000 units of serving trays. The beginning inventory for the year is 13,000, and its target ending inventory is 29,000. Compute the number of trays budgeted for production. So in this example, we're not talking about dollar amounts. We're talking about number of units. Be very careful. A lot of times in this chapter, students get confused because we're throwing dollar amounts around and we're also throwing units around. In this case, it's units. So this is the thought process on this. we are budgeting from the sales budget, and which is what we just finished an example of, 201,000 units we want to sell. In addition to selling 201,000 units for the year, we want to end the year with a finished goods inventory of 29,000. Therefore, my total needs, or my total required units, is the sum, or $230,000. I'm sorry, 230,000 units. Now, if I am required to have 230,000 units, if my beginning inventory is 13,000 units, the difference, or 217,000, is what I actually need to produce. So this is important. From your sales budget, we're able to know how many items we need to produce, or for sales purposes. And of course, when we consider our desired beginning and ending inventories, we are now able to figure out how many we need to produce. This is important because we will now go on and figure out our materials, labor, and overhead budgets. So this is a production budget. All right. We're moving on to, after production budget, we are now moving on to materials. So we're not talking about dollars yet, but we're talking about actual direct material, in this case, bottles, in items we need to purchase. Okay, here's the deal. The company produces wine. The company expects to produce 2,535,000 2-liter bottles in 2018. Dawson purchases empty glass bottles from an outside vendor. Its target ending inventory is 77,000. Its beginning inventory is 54,000. So this is very similar to what we just did with the production budget. We're going to start with how many bottles, in this case, direct materials, do we need for production? 2,535,000. In addition to that, we want a target ending inventory of 77,000. We want direct materials in the warehouse at the end of the year so we can at least have a good starting point for the next year. So our total needs, or total requirements, are 2,612,000 bottles. And if our beginning inventory is 54,000 bottles, that means the difference, or 2,558,000, are the bottles we actually need to purchase. So once again, in order, sales budget first, so we can figure out production. Production budget next. Once we know how many finished goods unit that we need to produce, we can now start to work on our materials, which we just did, our direct materials budget. And this is more of the same. Let's take a look at this. Okay, so for here, we're going to actually take, it's more of the same with the direct materials budget. So here, we have a sales budget of 42,000 finished goods for this 3-month period. We have a inventory of 13,000 units on hand at December 31st. That is our beginning inventory. Our target finished goods inventory is 15,000. It takes 3 gallons of direct materials to make 1 unit of a finished product. The company has 61,000 gallons of direct materials at the end of the year, or I should say at the beginning of the year, and a target ending inventory of 53 gallons at the end of the next year. How many gallons of direct materials should McGrath purchase during the 3 months ending March 31st? So you can get really confused with a question like this because the author of this question is actually giving you information for both finished goods units as well as direct material units. So don't be confused. They are 2 separate things. Our whole idea of a manufacturing company, is to take direct materials, add labor and overhead to it, and actually manufacture a finished good. So the first thing we need to do, if you come over here to the far right-hand corner, we're going to figure out the direct materials that we need to use. So we want to make 42,000 finished goods. Right? That's our sales budget. And we also have a target ending inventory of 15,000 finished goods. So our total needs or our total requirements are to produce 57,000 finished goods. If our beginning inventory of finished goods are 13,000, 57,000 minus 13,000, that means we need to actually produce 44,000 finished goods. Now, we said over here it takes 3 gallons. I'm up here in the question. It takes 3 gallons of direct materials to make one finished good. So if I take 44,000 items in finished goods times 3, how many direct materials do I need? And the answer is 44,000 times 3, or 132,000. So coming over here to the actual question or answer, we actually need 132,000 units of the direct material. And the author also told us our target ending inventory is 53,000 gallons, so 132,000 gallons to meet production needs. A target ending inventory for the direct materials of 53,000, so our total needs or requirements are 185,000. And we are expecting to have 61,000 gallons in the beginning of the year. 185 minus 61, that means we need to purchase 124,000 gallons of the direct material. Once again, this is different than the finished goods, so be very careful when you get a question like this where you have to break down the finished goods and the direct materials. Obviously, we need to figure out the finished goods production before we can figure out how many direct materials we need. In this case, it's a 3-to-1 ratio. We need 3 units of, in this case, gallons of a direct material to make one finished good. Okay, in this example, we're going to be looking more towards the labor budget. So once again, sales budget, production budget, materials budget, and now we're looking at the labor side. So we figured out how many units we're going to sell and produce. And so basically what we were given here is, you can see the data table over here on the right. This is what the author gives us. We figured out our estimated sales in units for January through May of 2018, 12,000 in January, 13,000 units selling finished goods in February, 6,000 in March, 11,000 in April, 11,000 in May. And here's the selling prices. The direct manufacturing labor hours per unit. So in January, it's going to take us 3 labor hours to make 1 unit. In February, the same, 3. But somewhere along the lines between February and March, we must have figured out a more efficient way to make our items. So now we're only dealing with 2 hours to make 1. March, April, and May. And here are our labor hours. $11 per hour in January, in February, in March, and it looks like our employees got a raise starting in April, $12 an hour, and May, also $12 an hour. So keep in mind with this data table. And so what we have to do is we have to figure out what are our total labor costs for this production level. So what we're going to do is something similar that we did in other homework questions. We're going to figure out, okay, our budgeted sales in units, like we just went over what was given to us. January, February, March, 12,000 units, 13,000 units in February, 6,000 units in March. That was given to us. In addition to the budgeted sales, we have to figure out our target ending inventory, because we still need to produce those. Even though they're not going to be sold in the current month, they're going to be produced in the current month. So that is something that we need to consider. And the author said that for every, the ending inventory is basically going to be, the target ending inventory is going to be, let me see if I can pull it up here. Yep, the author says here, the target ending of month inventory is going to be, and I'm highlighting it down here in the bottom right, 100% of the following month's sales plus 50% of the second following month's sales. So let me give you an example. January. All right, January sales are 12,000 and our target ending inventory is 16,000. How do I get the 16,000? It's 100% of the next month's sales, which is February, of 13,000 plus half of March. 6,000 for March, so half of it would be 3. 13 plus 3, how much is that? 16,000. You could do the same thing with February. The target ending inventory is going to be 100% of the next month. That's March of 6,000 plus half of April. And that chart we had, April sales are 11,000. So half of that is 5,500. 5,500 plus the 6,000, that's your 11,500. So just to give you an idea of how to figure out your target ending inventory. So the beginning sales, or the budgeted sales, plus your target ending inventory are basically our total requirements. In this case, for January, as an example, 28,000. We're going to subtract our beginning inventory. The author gave us our beginning inventory for January. It was 16,000. Subtract that from our total requirements. That's the number of units we need to produce. So for January, 12,000 units. And remember we said for January, they're going to take 3 labor hours to make 1. So 12,000 times 3, 36,000 hours. I'm sorry, 36,000 hours is required labor for January. February, sales, I won't go through March, but let me go through February so you have an idea. 13,000 budgeted sales. We figured out our target ending inventory was 11,500. That gives us our total requirements, 24,500, less beginning inventory. Beginning inventory is 16,000. Now the beginning inventory for February, how do I know what it is? That's the same as the ending inventory for January. All right, so be careful there. That's where you get it from. All right, subtract out your beginning inventory from your total requirements. You get the number of units we need to produce times 3 hours each. We got to spend 25,500 hours in February. And March, once again, the beginning sales plus your target ending inventory gives us your total requirements, less your beginning inventory. Once again, your beginning inventory for March is the same as the ending inventory for February. Subtract that out from your requirements, you get the total units you need to produce, 11,000. And remember, in March, we figured out a more efficient way to do our manufacturing, so we only need 2 hours of labor time to make each unit. 11,000 times 2, 22,000 hours. Now for the entire quarter, be very careful with this column. The budgeted sales you add across, January, February, March, 31,000. But your target ending inventory, 16,500 for the quarter, you don't add across. The ending inventory for the quarter is the same as the ending inventory for the last month in the quarter, which is March. So I want you to be mindful with this last column. It's not always add across. So sales plus ending inventory are our total requirements, less your beginning inventory. The beginning inventory for the quarter is the same as the beginning inventory for the first month in the quarter. Subtract that from your requirements, you get your total units to produce. And your total labor hours for the quarter, you add across. All right, so just wanted to point that out. Gets a little cumbersome with the quarter column. Now, how about the actual labor costs? So now that we figured out the number of hours that we need to spend, the number of hours that we need to work on our product, we can now figure out our labor costs. Our labor costs are as follows: wages, pension contributions, workers' comp, employee medical insurance, and the Social Security tax. So the author gave us a lot of that information, which we need to figure out. Okay, so first what we're going to do is figure out our wages. That's the big number. Now, the wages, as we said for January, our employees were earning January, February, March, our employees were earning $11 per hour. So if we simply take the 36,000 hours times $11, we're going to get our wages. For January, that would be $396,000. For February, 25,500 hours times 11, it'll give you 280,500. Pension contributions. The author told us with the additional information that the pension contributions is 40 cents per hour. So once again, 36,000 times 40 cents, 14,400. For February, 25,500 hours times 40 cents, $10,200, etc., etc. Workers' comp, the author told us it was 10 cents per hour. You do the same thing. Number of hours, 36,000 times 10 cents, 3,600 for January. For February, 25,500 hours times 10 cents an hour, 2,550. I think you're starting to understand this. It's pretty simple. Medical insurance, the author told us in the additional information, 50 cents per hour. So once again, January, 36,000 hours times 50 cents an hour, $18,000 for medical insurance. February, 25,500 hours times 50 cents per hour, $12,750. And last but not least, Social Security tax. The Social Security tax in this example is 7.5% that the author was giving us. So if they make $11 an hour times 7.5%, the Social Security tax per hour works out to 83 cents per hour. And you use your 83 cents per hour to figure out your Social Security tax in dollars. 36,000 hours times 83 cents, $29,700 for January. February, 25,500 hours times 83 cents, and you'll get your Social Security tax, $21,038. So, labor costs. This comes after, obviously, the sales budget, the production budget, and the materials budget. These are starting to be the conversion costs. Remember, the conversion costs are the labor and the overhead to convert our materials or our raw direct materials into a finished good. You have to add labor and overhead to do that. So that is why labor is part of the conversion costs. What we're doing in this homework example is a cash budget. And you have to realize a cash budget, cash flow, or the timing of cash flow is critically important. If we have credit card sales, it's usually pretty simple because the credit card company usually gives us the cash in our bank account literally the next day. So the timing difference between the time of the sale and the time of the cash collections is very negligible. So, and that's what we have here. We have sales of both, let me see, we have sales revenue. Let me read what we have here. We sell home oxygen equipment. So we sell the actual equipment, and we also sell service contracts. The service revenue is $200 each month, all right, for customers. And what we have here, you can read the information. It says almost all of the sales revenue of the equipment are credit card sales. Cash sales are negligible. The credit card company deposits 97% of the revenues recorded each day into HealthMart's account overnight. For the servicing of the equipment, 60% of the oxygen services billed each month is collected in the month of service, and 40% is collected in the month following the service. So you can see there's a timing difference between when we are actually going to receive the cash. We might sell in 1 month, collect only 60% in that month, and then of course 40% after. So let's take a look at what we have here. The data table given to us in March, where expected sales revenue is $6,000 and the service revenue $4,000. So sales revenue of the equipment, service revenue, servicing the equipment, and then our totals. All right, so that's kind of our sales table. So if we're trying to figure out our quarter, which is April, May, and June, first let's take a look at the equipment sales. So April, we said our sales for our equipment down here on the table in the bottom right was $8,000, and we're going to collect 97% of it. Remember, where did the 3% go? Well, the credit card company kept that. That's their fee. So we're not always going to collect 100% of our credit card sales. We have to pay the credit card company. And in this case, it looks like it's a 3% fee. So April, $8,000 times 97%, that will all be collected in April. May, $7,500 in sales times 97% collected. So we're going to collect $7,275 in May. And then June sales are $9,000 times 97% collection rate. We will collect that in June. All right, now the service revenue. For March, it was $4,000. Remember, $4,000. That was collected 60% in March, but 40% in April. 4,000 times 40%, that's going to be collected in April. You see we're in the April column here. All right, and let's go down to April. April's service revenue in the bottom right was $4,200. That is collected 60% in April. And the other 40% is going to be collected in May. All right, so you got to make sure you put the numbers in the correct columns. And lastly, May was, or not lastly, but May service revenue was $4,400 according to our table. And that $4,400 times 60% collected in May, and the other 40% collected in June. And last but not least, June service revenue is $4,600, and that is collected 60% in June, and the other 40% will be collected in July, but we're not interested in July for our table. So according to our budget, we are to collect $11,880 in April, $11,595 in May, and $13,250 in June. All right, that was kind of our calculation of the amount of cash inflow that we are going to get each month. That is only one piece to the puzzle for the entire cash collections. I'm sorry, for the cash budget. We have to consider the cash outflow as well. All right, so the next requirement is to actually do the full cash budget. And basically, what it says here is, for the cash budget, it says we must maintain a minimum cash balance of $250 every month. That is kind of our internal rule. All right, so how are we going to do our cash budget? We're going to start with our beginning cash balance. The author told us our beginning cash balance for May is $400. The cash receipts are basically what we figured out up above. $11,595, and that's we got from above, May. You see, I'm highlighting it, $11,595. So beginning cash balance, add in the expected receipts, that's the total cash available for our needs. Well, the author told us that we are going to spend $11,000 on our disbursements. Okay, $11,000, that was given to us. And so if we had $11,995 minus the disbursements of $11,000, all right, and if the minimum cash balance desired is $250, that basically means we need $11,250. We need the money for our disbursements plus our minimum balance. That's $11,250. If we have $11,995 available to us and our needs are $11,250, our excess cash is $745. So that's good. We're above our minimum cash balance of $250. If we weren't, then we would need to go ahead and borrow money if we had an available line of credit for us. Now the second requirement basically assumes, let's do a what if scenario. What if our May revenues decrease by 10%? Or may costs increase by 5%? So if you have these what-if scenarios, the receipts are going to change. If our May revenue decreases, you could see our receipts are going to decrease. If our May costs increase, you're going to see that the receipts would be the same as the original, but what will be different is the disbursements. They're going to increase. All right, and so you can see the worked solution over here. So if the May sales revenue, which was originally $7,275, if that's going to decrease by 10%, my new sales revenue for May is going to be $6,547. All right. The April service revenue collected in May, all right, is still going to be the $1,680 from the original table, but the May service revenue is going to be different, right? It's going to be $2,640 which the original, but it's going to decrease by 10%. Okay, so you can see our service revenue has changed, and we just need to carry over the 10% decreases, in this case, to our original sales revenues. Okay, now how about the disbursements? And this is an example. If the disbursement increased by, or costs, the disbursement increased by 5%, it was originally of $11,000, and multiply it by 105%. Our new budgeted cost or disbursements is $11,550. So these what-if scenarios are important to make sure that we know what's going to happen if we have, well, what if this happens, or what if that happens? So we can see, well, in the case, if revenues do indeed decrease by 10%, we have a cash deficit. We actually have to go out and borrow money. So this is something that we need to consider when we're doing these cash budgets. A lot of times we want to do what-if scenarios or sensitivity analysis. Certainly very important. Here we're going to put together a budgeted income statement for 2018. And in order to do this, we're going to start with our income statement for 2017, which you see on the far right over here, the upper right-hand corner of your screen. And so in 2017, we had revenues from two sources: selling equipment, $8,000, and selling maintenance contracts, $1,900. So that's a total of $9,900, less your cost of goods sold of $4,000, gives you your gross margin or gross profit of $5,900. Less all of your operating costs, marketing, distribution, customer maintenance, administration, gives us total operating cost of $2,750. Subtract that from your gross margin, and you get your net operating income of $3,150. So that's our starting point. And basically, from the starting point, we know we were given some additional information, and that's in this in the middle of your screen. We have 1 through 7. Some additional information that we know for 2018. And number 1, it says selling prices of equipment are expected to increase by 10% because the economic recovery is beginning. So we're doing some analysis, and we figure that the number of units we're going to sell are going to increase. Or I should say the selling price are going to increase by, we're going to be able to sell them for 10% more. All right. In addition to number 1, look at number 2. This is important as well. It says the equipment sales in units are expected to increase by 6%, with a corresponding 6% growth in the units of maintenance contracts. Let's take information 1 and 2 and work it into our new revenue items. So for equipment, the 2017 amount was $8,000 per last year's income statement. I'm going to be able to increase my selling price by 10%. So I will multiply the $8,000 times 110%, or 1.10. Also, in addition to the 10% increase in the selling price, we also have a 6% increase in the number of units sold. So we will also multiply it times 106%. 8,000 times 110% times 106%, you get 9,328. That is going to be our budgeted revenue number, and I'm putting it over here on the left. This is our budgeted income statement. How about maintenance contracts? Well, last year it was $1,900. And we didn't say anything about an increase in sales price, but we did say that our maintenance contracts will also grow by 6%. So we'll multiply it by 106%. Our new budgeted sales for maintenance contracts, $2,014. And so I'll put that over here on the left in my budgeted income statement. You add the equipment and the maintenance contracts, that is your total revenue estimate, $11,342. How about cost of goods sold? Well, let's take a look at number 3, what was given to us. Cost of each unit sold is expected to increase by 5% to pay for the necessary technology and quality improvements. So, with cost of goods sold, in the prior year it was $4,000. And so what we have to consider is a 6% increase in sales. So we'll take that $4,000, multiply it by 106%. In addition to that, we need to increase the actual cost by 5% for new technologies and new quality improvements and whatnot. So the new cost of goods sold is $4,452. And we'll take that over here to the budgeted income statement. All right, so total revenues less our cost of goods sold gives us our budgeted gross margin of $6,890. And how about some of our other costs? Marketing was originally $630 in the prior year, and it says marketing costs are expected to increase by $290,000. All right, so $630 plus $290, the new budget cost is $920. So we'll take the $920 over here. Remember, these numbers are in thousands. Distribution, it was $100 in the prior year, and distribution costs will vary in proportion to the number of units sold. And we said the number of units is going to increase by 6% earlier, so that is going to go up to 106. 100 times 106%. All right, customer maintenance was $1,100 over here. And we said that the maintenance technicians, we're going to hire a couple more at a total of $160,000. So if we take the $1,100 plus the $160, that's where we get our new number, $1,260. And last but not least, administration, it was $920, and we're not expecting any changes to the administration. So that'll also be $920. And when you work that all out, you add up our 4 marketing costs, $3,206, subtract it from the gross margin of $6,890. You are left with operating income of $3,684. You can see that has increased somewhat from the income from the prior year. So something to keep in mind. Obviously, we need to do all of our other budgets first, our materials, our labor, our overhead, our selling administrative budget. You need to do all of those first before you can tackle a budgeted income statement. Here we're going to put together a cash budget with some information given to us. And so over here in the middle, basically this was given to us. So the revenue budget, which was put together earlier, we're going to sell a total of $178,400 worth of materials. All right, now the cash budget, once again, we're going to start with our beginning cash number, which the author gave us as $5,900, and we're going to add in our receipts. Well, just because we're selling $178,400 worth of items doesn't mean we're going to collect all of that. So we need to convert this $178,400 into cash receipts. Well, the author tells us over here that we don't make any credit sales. All of our sales are done with credit cards, and we basically collect 90% from credit cards, and we get the cash right away, less a 2% transaction fee, and the other are cash sales. All right, so no credit sales, but we do have credit card sales. The total sales of $178,400 times 90% are credit card sales, and we will multiply it times 98%. Remember that 2% fee is kept by the credit card processor. So the cash from the credit card sales are going to be $157,349. The cash sales Well, the total sales times 10%, that's the cash sales. If you add up the 17,840 and the 157,349 over here on the left, we're doing our cash budget. So beginning cash plus the receipts, that gives us cash available. So $181,089. From there, we're going to subtract out all the cash we need for our disbursements. Our disbursements are basically going to be our materials, our labor, our overhead, and our other overhead items, non-manufacturing salaries, sales commissions, our fixed costs, and of course our capital expenditure if we're going to buy any fixed assets, and of course any taxes. So the author gives us a manufacturing overhead budget. This is something that we would have computed before we did a cash budget. But the author is just giving it to us and says $109,832 is our overhead budget. Now, out of that $109,832, if we read the additional information down here, it says out of that $109,832, depreciation of $25,000 is in that number. So even though we have $109,832 as the budget for the overhead that we're going to pay for in the same month, $25,000 of it is depreciation. And remember, we don't write a check for depreciation. There's no such thing as writing a check made payable to Mr. Depreciation. All right, so we're going to take that out. It's an expense, yes, but it's a non-cash expense. So our total actual cash disbursement for overhead is going to be $84,832. So let me put that there, $84,832. How about direct materials? I forgot that one. All right, we got to come up here for direct materials, $18,012. Well, the author said materials are purchased on account. We pay for half of the materials in the same month that we purchase it, and the other half in the following period. At the end of March, the company owes suppliers $8,000, and during April, they plan to purchase materials of $20,024. So for April, how much am I going to disperse? I will disperse the $8,000 I owed from March plus half of April's purchases, 50% of the $20,024. If you do the math, that's direct materials purchases cash disbursement of $18,012. All right, so we got the beginning cash. We took in our cash receipts. We looked at the materials. We looked at the overhead of $84,832. How about labor? Well, the author said their labor is $27,300. That'll all be paid out in cash disbursement, so that's that number. Next, we have non-manufacturing salaries. Okay, non-manufacturing salaries. Here it is on this list that the author gave us. $16,800. $16,800. Sales commissions, $1,784. $1,784. We have our other fixed costs are $16,000. But when you read down here, it says out of that other fixed costs, $10,000 of them, $10,000 of the other fixed costs are for depreciation. So the cash disbursement for other fixed costs is $6,000. So we'll take the $6,000 and put it over here on the cash disbursement. The author also goes on to state that we are going to buy fixed assets of $13,000 in April. So that is our capital expenditure there, $13,000. And the author also goes on and says that we owe, and I'm circling over here in the bottom right, the company owes $5,000 in income taxes that we will indeed pay in April. So that also goes on the cash disbursements list. So we'll take our cash available, $181,089, subtract out all of our cash disbursements, totaling $172,728. You get a cash excess of $8,361. And last but not least, the financing part. The author says that we had a loan of $2,000. It's over here in the other information. Let me see. The company has a $2,000 loan at an annual interest rate of 12%, and the interest is paid at the end of the month. So, because we have greater than a $7,000 cash balance, we'll be able to repay that $2,000 loan, plus the 12% interest for a month, which is $20. If you subtract that off of the excess cash, you get ending cash at April 30th of $6,341. So that's a cash budget. Remember, the key with the cash budget is sometimes we need to convert what we learned with our sales budgets and our materials, labor, overhead budgets. That's one thing, but sometimes we need to convert it to cash inflow and outflow, which might be a little different than the actual sales and expenses that we're budgeting for. This is a very simple homework example. This is basically just putting the order together. And as I've been saying all along, we got to put our sales budget together first. Then we can put together our production budget, know how much we need to produce. And then from there, we could put together our materials, labor, and overhead budgets, ending inventory and cost of goods sold budgets. They kind of go hand in hand. Then we have our selling, general, administrative budget. And then ultimately, we can budget for our income statement. It's a very simple exercise dealing with an overhead cost budget. And remember, overhead costs come in two flavors. We have variable costs as well as fixed costs. So the author over here gave us some data. As an example, we make two types of lamps, NOx and air. NOx, we want to make 20,000 lamps, and the lamps are produced in batches. So each batch has 100 lamps. So if we have 20,000 lamps divided by 100, that gives us the number of batches that we are going to make. So if we take that number and multiply it by 3, that is the setup time. All right? And the setup time is going to be the variable cost. So let's do the math here. Get out your calculator. If we have 20,000 lamps divided by 100 lamps per batch, that means we're making 200 batches. Each batch takes 3 hours to make. So I'll take 200 times 3. That's 600 hours. And the variable cost per hour, as you see here, is 60. So if I take my 600 times 60, that is $36,000. All right, $36,000 would be my variable cost for NOx. Now about let's look at air. 10,000 lamps, so put 10,000 in your calculator, divided by 80 lamps per batch. That's 125 batches, times 4 hours per batch. That's 500 hours. 500 hours times $60 per hour. That's $30,000. So $30,000 for air, $36,000 for NOx. That's a total of $66,000. That is your variable cost. And your fixed, the author told us, was $143,000. So very simple homework example. It's really just making sure you understand that the overhead comes in both the variable piece as well as the fixed piece.